Have you ever wondered what keeps the financial gears of an economy spinning smoothly, ensuring there is always enough money flowing for businesses to grow and people to invest? It is a bit like the circulatory system of our economy. Well, a key mechanism central banks use to inject money into this system and increase its overall liquidity is called an open market operation, or OMO. Specifically, when a central bank buys government securities from commercial banks, it directly increases the amount of available money within the banking system. Here is how it works. Imagine the central bank purchases government bonds from a commercial bank. The central bank pays for these bonds by crediting the commercial bank's reserve account. These reserve accounts are held at the central bank, and they representing money that commercial banks can use to satisfy reserve requirements or, more importantly, to lend out. When a bank's reserve account increases, it suddenly has more funds available than it might immediately need. This surplus of funds, often called excess reserves, makes banks more willing to lend money to other banks, businesses, and consumers. As more funds become available for lending, the cost of borrowing for banks, known as the federal funds rate, tends to fall, signaling lower interest rates across the economy. So, what does this mean for you and the broader economy? With more money flowing and lower borrowing costs, businesses find it easier to take out loans for expansion, leading to job creation and increased production. Consumers might see lower interest rates on mortgages, car loans, and credit cards, encouraging them to spend and invest. This increase in lending and spending activity is exactly how OMO buying operations stimulate economic growth and boost overall financial liquidity. It is important to know that these buying operations effectively expand the monetary base, which is the total amount of currency in circulation or held as commercial bank reserves at the central bank. While some OMOs are temporary, using repurchase agreements to manage short-term fluctuations, outright purchases have a more lasting impact by permanently adding reserves to the banking system. This distinction between temporary and permanent operations highlights the central bank's precision in managing liquidity. By skillfully buying government securities, central banks ensure a healthy and robust flow of money, providing the necessary lubrication for economic activity. This fundamental action supports a stable financial environment, empowering businesses and individuals to thrive and contribute to a flourishing economy.